If you have ever wondered how the stock market really works, but every explanation felt like Wall Street jargon, stick with me for 3 minutes. Here is the simple version. A stock is a tiny slice of ownership in a company. When you buy a share of Apple, you own a piece of Apple. If the company grows and makes more money, that piece can become more valuable. They might even pay you dividends, which are cash payments from profits. Where does all this happen? On stock exchanges, NYSE, NASDAQ, markets that match buyers and sellers. Companies go public through an IPO, listing shares so anyone can buy them. After that, shares trade every weekday during market hours. Prices move because of supply and demand. If more people want to buy than sell, price goes up. If more want to sell, price goes down. What drives that? Earnings reports, interest rates, economic data, news, fear, and greed. You will hear market cap, that is price times number of shares, a quick way to size a company. Bid is what buyers offer. Ask is what sellers want. The difference is the spread. When you place an order, a market order buys at the best available price right now. A limit order buys or sells only at a price you set. You do not have to pick individual stocks, index funds, ETFs, S&P 500. One purchase, instant diversification. Lower risk than betting it all on a single company. Risk is part of the game. Stocks are volatile short-term, but historically grow long-term as businesses innovate and economies expand. Diversification spreads risk across sectors and countries. Fees and taxes matter. Expense ratios, commissions, capital gains, dividend taxes. These can eat into returns, so keep costs low and know your tax rules. Here is how I would start if I were new. Step 1. Build an emergency fund, 3 to 6 months of expenses. Step 2. Pay off high-interest debt. Step 3. Open a reputable brokerage account. Look for low fees, good research tools, fractional shares. Step 4. Define your goal and time horizon. Money needed within 3 years should not live in stocks. Step 5. Start with a broad market index ETF. Automate contributions. Let compounding work. Step 6. If you want to pick stocks, cap it at 5 to 10% so one mistake does not wreck your plan. Quick myths to ditch. Myth. You need to time the market. No. Time in the market usually beats timing the market. Myth. You need a lot of money. Many brokers let you start with $1. Myth. More trades mean more profit. Often, more trades mean more fees and more mistakes. Action time. Pick one brokerage. Choose one low-cost index ETF. Set an automatic weekly amount, even $10, and let it run for 90 days. While it runs, learn. Read earnings summaries. Watch for Fed rate moves. Practice placing limit orders with tiny amounts. You do not need to be perfect. Be consistent. Start small. Stay diversified. Keep costs low, and give it time.